Hello, Assalamu alaikum. My name is Danish Kazir. Today we are going to discuss International Accounting Standard 16, which is called IAS 16, and it talks about the property, plant, and equipment, the capital expenditure which the company incurs. We would discuss the depreciation, what is depreciation, then we would discuss what constitutes the cost of the asset, and lastly we would discuss the measurement after recognition. So firstly we need to understand what is capital expenditure, capex, and operational expenditure, which is opex. So capital expenditure is the expenditure which is incurred and which is capitalized, which means that the amount is shown in the balance sheet in the assets column, which means that every company has a certain amount of threshold. For example, if a company spends, for example, $5,000 on on an item, it could capitalize it and present it as an asset, and that would be termed as a capital expenditure. And operational expenditure is known as the day-to-day expenses. For example, the routine maintenance, repairs, maintenance, and the supplies, the office supplies, and the professional fee, audit fee, etc. So all these are mentioned as operational expenditures in the P&L. So the basic difference is the nature of expense. Capital expenditure is an expenditure which is incurred in the acquisition of assets, or an expenditure which could significantly upgrade the asset in terms of its useful life. So this is called the capital expenditure. Now we would come to depreciation. So every asset is basically depreciated, and there are two methods to depreciate. First, the straight line, and second is the reducing balance. Depreciation is a non-cash expense, which means that if an asset which costs 100 rupees, if it has a useful life of 5 years, so it would be depreciated at 20 rupees per year. So the idea is that the cost of the asset should be spread over the useful life of the asset. And so this is the straight line method. The reducing balance method assigns a certain percentage on the asset. For example, the asset would be depreciated on 10% per annum basis. So every year the net book value would be different, and the depreciation expense would also be different as opposed to straight line method. In the straight line method, the depreciation expense is same every year, and the asset becomes nil at the end of the useful life. And thirdly, there's a concept of accumulated depreciation. So whatever depreciation you are charging on a year-to-year basis, that is accumulated in this account. So this is basically a negative asset account which appears as a negative on the balance sheet. Now the asset is measured at recognition, which means what the question arises that what constitutes as a cost of asset. So first, of course, the most obvious thing is that the purchase price would be considered as the cost of the asset. Then there are other costs which are known as directly attributable costs. For example, if a company intends to install, commission a factory, there would be various types of expenses which the company would incur. First would be site preparation. The site would need to be prepared. Then there would be installation and assembly costs. Then there would be cost of testing, and there, of course, there would be professional fee. The architect would come, the legal advisor. There could be other government dues. So all of these things would be capitalized. Why? Because without these costs being incurred, the asset could not have been brought into the working condition. So which is a requirement of IAS 16, that whatever cost you are incurring to bring the asset into working condition, that has to be capitalized. Now once the asset is capitalized, you need to opt for any of the two models. So first is the cost model. Cost model is simply cost less accumulated depreciation. So this is pretty much simple. You know the cost, and the depreciation is applied as per the approved method. Second is the revaluation model, that you revalue the asset on a yearly basis. Usually a professional firm is engaged in this activity, so a company cannot come up with some magical value from its own side. It has to engage a valuer, and the valuer would inform you what would be the valuation, and that would be could also be further subject to audit by the external auditor. So this is basic introduction about the IAS 16, and then there are disclosure requirements. There is a, a method of presenting the assets. So you need to present the cost and the accumulated depreciation and rent book value, and you need to present the assets as in their basic categories. For example, furniture and fixtures, motor vehicles, and plant and machinery, tools and equipment, etc. So all these major line items would be appearing in the disclosure, and the face of the balance sheet would be showing the non-current assets under the heading non-current assets and property plant equipment. So thank you for watching. Then don't forget to subscribe.